Hello again. We are actually jumping into module 10. We're skipping module 9, about equity investments. But we're going to go into module 10 as part of this week. So hopefully you've seen the module 8 videos. There are 3 elements associated with module 10. We're going to do a deeper dive in leases. I want to make sure you have a good handle on leases because there are some new rules came out in 2019 greatly affecting the balance sheet, increased assets, increased liabilities. If you look between 18 and 19, you saw some pretty major changes typically on the balance sheet associated with companies, which could play some havoc with some of the ratios and analysis. We will be going a deeper dive in deferred taxes because the IRS has tax rules that are not GAAP. They're IRS rules, and then GAAP has rules. Sometimes it'd be consistent. Most small companies, yeah, I'm going to do GAAP. I'm going to do the IRS rules, and that's going to be my books. But larger companies often will be different. GAAP can do straight line or accelerated depreciation. IRS says accelerated depreciation only with a mid-year convention. First year, you only get half depreciation. You say, I bought this in January. I want to get most of the depreciation out of it, and you can on your books. There's LIFO, lasting first out rules that say if you lose LIFO for GAAP, the IRS requires you to use LIFO in your books for tax purposes too. You can't kind of go back and forth. There are a bunch of IRS rules, tax rules that may or may not be close to what GAAP would give you. So if you got a tax rate 25%, but the actual income with the IRS versus income with GAAP is different, you're going to pay a different tax rate, and you want to record a deferral and recognize that and say, well, I got to pay my taxes later. I've got more cash now. I can pay less taxes now. And that's usually an advantage. The other area is pensions, which the only thing you're going to hear about pensions from this module is right here, right now. And I want to make sure you understand that there's 2 kinds of pension benefit declarations. One is when you get a 401k and your company matches that, well, that's a defined contribution plan. They are contributing to your 401k as you are contributing to your 401k. And at the end of your employment, you take your 401k with you. Congratulations. So that's a defined contribution. But the defined benefit says, wait a minute, if you work for us for 20 years, 30 years, 40 years, you're going to get so much a month benefit. You're also going to have so much in healthcare. And those are benefits you've earned just because of your longevity with the company. Those plans are pretty expensive for larger companies or the government, state government, federal government. They usually have pretty good benefits. But all those benefits are kind of on the way out overall, especially in the corporate world. So the defined contribution is taking dominance as opposed to the defined benefit type plans. But you really don't have to know anything for the quizzes and exams that we're talking. So you're probably going to say, good, whatever you just said, that's nice, but let's get to leases and deferred taxes. So we have 2 modules here, or 2 learning objectives, which I will cover. Let's jump into leases. I'm going to go in and we're going to take a look at lease disclosures and what that's about. So when we look at leases, we want to take a look at what is a lease in the first place. Contract between owner of an asset, the lessor, and a party that uses the asset, the lessee. So think of car loan. Well, you can think of it as a car loan, but think of a car lease. You might lease a car for 3 years. Might lease a car for 5 years. You don't own the car. You still have to maintain it. When you return it, you got to make sure there are no dents. If you had to go through new tires, you had to do the oil changes and maintenance. Those are things that you were responsible for while you were using somebody else's car. It's not your car. But they're usually cheaper to get into because let's say you had a 5-year vehicle, and after you return the vehicle, it's only you paid $40,000. It was a $40,000 value. You returned the vehicle, it was worth $25,000. So that's say a 3-year, 3-year lease, $40,000. We'll drop it down to $20,000, half price, 3 years. What's going to happen? You're financing $20,000 worth, not all $40,000. If you took out a car loan and bought the thing, you'd have a $40,000 loan and with every down payment you came up with. If you are just leasing it, you're financing 20 grand, and what you're doing at the end is saying, here's the car back. Now you might have an option to buy based on that $20,000 valuation. And frankly, if you took out a lease 3 years ago, that would have been a great deal because the used cars 6 months ago were crazy money. There was a shortage of chips, so people, used cars went crazy, new cars went even crazier, above list price. Well, what's going on? So you were able to buy a $20,000 car, which is actually for 20,000, car that's probably worth 25 or 30, and you're going to execute that in any way you can when you're at the end of your lease term. But typically, there's not a requirement, and it could go the other way. Maybe there's a glut of used cars out there now, and the value falls down. I don't know if anybody remembers cash for clunkers, but that was one of the unintended consequences. Is used vehicle prices also jumped at that time, and that was one of those unintended consequences that the government didn't realize. Oh, we're going to destroy all these perfectly good cars. They're not going to be used cars available for purchase anymore. So the real beaters out there have gone up in value. The existing used cars have gone up in value, and it really played havoc with the marketplace. But we're not going to go down that path. But it is a contract, unrestricted right of use of the asset with periodic payments. But the lessor, the person that has the original ownership, still owns it, and they let you take physical possession as a lessee. Think of it, as I mentioned earlier, like financing. It's like a bank loan, but you're financing the difference between the current value and the value at the end of the lease, discounted to today. So when leases, where there's less equity to put into it, lease terms can be structured any which way you want. Warning though, leases are typically a bad idea for individuals. No, not just a bad idea, a terrible idea. Why is that? Well, what's going to happen at the end of a 3-year lease? You're going to give back the car. You just basically finance the highest, the first 3 years of the heavy depreciation. That was nice of you. You paid for that depreciation. So what happens at the end of the lease? The car goes back to the dealer. They say, great, I got a used car I can sell. And they're not going to think, you're probably not going to take your bicycle to the dealership with your car and say, you take the car, I'm going to ride my bike. They're going to sell you another car. So they're in a pretty good position saying, yeah, I think you're going to need a car since this car is disappearing out from you and coming back to me. So you're probably going to go have to get another car. And if you bought it, that's on you. You can sell it when you want. You can dispose of it when you want. You can drive to the ground if you want. So less equity. Now, situation, if you're a realtor and you don't have a lot of money, you might say, I don't have any down payment. I'm going to go lease a car because I got to show off to my clients I'm driving a nice car. But typically, you're better off not leasing individually. I've leased for business purposes, and sometimes it's not a bad idea. But again, I personally, I always own, and that's a personal thing. Lease terms can be structured any which way you want them. And for vehicles, equipment, and real estate. And again, we just said, if you rent a facility for 5 years, you got to put it on the books, assets and liabilities. This is 2019. We're not going to deal with any pre-2019 stuff. Even though there's a bunch of stuff in the book about it, since this is a current accounting class, it is the current year is going to be past 2019. We're not going to worry about the old stuff because we're not going to do that much historical analysis. But I do want you to be aware of the new lease rules, the new lease regs, and how they get categorized and what goes on with them. So we've got 2 categories we're looking at: a finance lease and an operating lease. Okay, finance. Well, it sounds like exactly what it is. You're financing the asset, and it's basically like a purchase. You'll end up owning the thing because there's either a bargain purchase option or ownership goes back to you at 0 cost at the end of the lease. And if it's not a finance lease, then it's an operating lease. Okay, you can use and control the asset, but ultimately the asset is most likely to go back to the lessor when all is said and done. So adopt new standard. There's a couple of options. You can do retroactive adoption or prospective. I just want to talk about the terms for a minute. Retroactive is you go back in time and say, let's pretend we had that leased equipment. Let's put it on the books like 2019 rules say, or put that in 2018 and 2017. Or prospective. We're just going to do it from 2019 on, from here on out. And there are adjustments when you change rules. Let's change appreciation. I got this building that I thought was going to last for 40 years. And 10 years later, I say, well, actually, it's really well built. It's actually going to last another 50. So that's 40 plus 10 plus 10. That's 60-year life. From here on out, prospectively, I'm going to change it to a 50-year depreciation than my 10-year point. I'm not going to go retroactive and start when I built the building 10 years ago and adjust all my depreciation, adjust all my financial statements. I'm going prospectively from here on out. And that's what we typically do with the lease rules too, although retroactive is an option. New standard adoption, Microsoft. They used a retroactive approach, restated its prior year financials to go with that. So you have actually comparable statements. And that's actually a good way to do it, good way to communicate. And then we go in and we see assets, cash, short-term, yada, yada, property, plant, and equipment, operating lease, right of use assets. There it is. There's our asset for capitalized leases showing up on the long-term assets on the balance sheet. So they have to be there. They also show up on the liability side on the obligation to pay. That's how it balances out. So here's the liability, current portion, long-term debt, operating lease. So by the way, finance leases are considered debt, or operating leases are considered operating lease liabilities. And we have a current portion of long-term debt, all three of those. Now the current portion of this debt, long-term debt associated specifically with the leases, will be shown, and then the operating. So we have three parts of the liability side on the balance sheet showing a lease. Financing leases, again, financing versus operating. We have transfer of ownership on a finance lease. You own it in the end, bottom line. Any one of these criteria needs to be met. Transfer of ownership, purchase option. Yeah, I'm pretty sure I got all these computers, I can buy them for $1. Okay, I'm probably going to pay the $1 at the end of 5 years or 10 years because someone's probably still using them, and maybe I'll give them back. The chances are I'll buy them. My lease term is for a major part of the economic life, typically 75% or 3/4 of the life. You know what? I've used up this asset for most of it. Okay, so that's something that you want to take into account. If it's 75% of the asset that you are getting. Present value of lease payments and any residual guarantees equals or exceeds all the fair value. So bottom line, not just the portion that I'm leasing it for, but the fair value of the whole thing. I'm paying for all of it, even if my lease ends in 10 years, I still paid for more than the value of the fair market value discounted to today. And then specialized assets, nobody else can use it. I have specialized software I may have developed, specialized chips and computers I may have. Car, anybody can use, but some of the computer programs is not geared for anybody. And then any lease of 12 months or more not classified as a finance lease is considered operating lease. And what do we have on the balance sheet? Lease obligation. We have lease payments made to the lessor before the lease commencement date. We have incentives received from the lessor and the initial direct costs associated with incurring the lease equals our right of use asset showing up as an asset on the balance sheet. And we, as I said, present lease liabilities and right of use separately, not the net amount. Finance leases are typically including property, plant, and equipment, and lease liabilities with debt. Operating leases, separate line item if material. So we have a separate line item that shows up on the balance sheet to each. Lease liabilities, footnote disclosure, future lease payments. We want to know the whole point of the lease rules as they were recorded was to recognize the fact that we got to pay stuff out. We couldn't hide it anymore. I might have rented 100 cars and I'm paying, car lease expense on my income statement. Doesn't show up in a balance sheet. But somebody bought the companies, they're going to say, wait a minute, I got 100 cars I'm on the hook for. Same thing for a 10-year lease on a building. Oh, I'm on the hook. Well, it'll show up now on the balance sheet and on the balance sheet as an asset and liability, where previously it did not have to. So this is actually a good change. Get to see more, get to do more. And then the present value of operating lease payments. You want to discount those lease payments to today. That's what shows up as a liability. Not the total dollars you're paying, but the discounted total amount. Similar to when we did that bond discount stuff and trying to find the valuation of a bond. Discount rate for leases, you can go through the calculations. Where did we get the discount rate? Internal rate of return function estimates the discount rate that is used on leases. If you know the rate, you're supposed to use that. If you don't know the rate, you can impute the rate. Income statement, lifetime, and there are financing costs. So you have the asset, and you're going to be paying off that asset over a period of time. There's the lease liability, and you have the expenses associated. I know I'm going through this kind of fast, probably about 4 or 5 more slides. But the bottom line is I want you to know about leases and the obligations, not a lot of detail. We're not going to do a lot of calculations on leases for this segment because I did combine two chapters, two modules, 8 and 10. So I don't want to overload you, but I just wanted to make you aware of the flow and the process and how the income statement sees things, how the balance sheet sees things, because we're going to do a deeper dive on financial statements, and I want you to be aware of this stuff. Then the statement of cash flows will be impacted, operating activities for the lease payments themselves, financing interest on the principal associated with the lease obligation as well. Summary of lease accounting. Yeah, there's a table here. You can read all about it. But both operating and financing leases, the balance sheet will treat the same. The income statement, a statement of cash flow, depends on the classification. So is it cash flow from operations or is it cash flow from financing? Again, if it's financing lease, obviously it'd be financing. If it's something that is geared towards the operations, there's something you're going to end up as owning in the end. I'm sorry, as operating as part of the operations. And then Delta talks about non-current assets increased by 5.9 okay, $6 billion. We'll round it up. Went from 0 to 6 billion. Okay. Delta's liability increased to 6.75 billion, 5.8 non-current. Okay, so there's some pretty heavy dollars involved. And the last slide on leases, 2 significant analysis issues. We're not going to worry about prior to 2019, but we are going to worry about the post-adoption cash flows, and you lose the ability to compare. So there's going to be a transition for understanding. And analysts capitalize prior year's operating leases using footnote disclosure. The footnotes are important. They actually tell you why the numbers are there. And if you want to make adjustments for comparability reasons, we had that LIFO reserve that shows up last year, current year. We have things like lease obligations, and whenever GAAP changes, we want to know about it. Inquiring minds want to know. So that concludes our lease conversation. We're going to jump into deferred taxes in the next video. And again, it's going to be more of an overview, again, familiarity, which is what I want to get at for this particular module, module 10.